One of the biggest misconceptions people are taught is that their money is growing simply because it is sitting in a bank account. Yes, the number might slowly increase because of interest, but that doesn't mean your money is actually gaining value. When inflation consistently outpaces bank interest rates, the purchasing power of your cash is quietly shrinking. In real terms, holding excess cash is often less like saving and more like slow financial erosion. This is why wealthy individuals rarely rely on bank accounts to preserve long-term value. Instead, they spread their money across assets designed to resist inflation and protect purchasing power over decades, not months. The goal isn't speculation. It's preservation first, growth second. One of the oldest and most widely used stores of value is precious metals. Gold, silver, and platinum have been trusted for centuries because they are scarce, durable, and costly to produce. Unlike fiat currencies, they cannot be created at will. When governments expand money supply to fund spending, tangible assets with limited supply tend to hold their ground far better than paper currency. This is why high net worth investors often allocate a portion of their portfolios to precious metals, not for excitement, but for stability. Exposure doesn't even require physical storage anymore. Modern investment vehicles allow people to track metal prices efficiently without handling bullion. Beyond precious metals, raw materials play a critical role in the global economy. Industrial commodities have intrinsic value because modern life depends on them. Metals like copper, nickel, and cobalt are essential for infrastructure, electronics, energy systems, and emerging technologies. Their usefulness creates persistent demand that can't easily be replaced by alternatives. While most individuals can't store or trade physical materials, they can gain exposure through mining companies, commodity-focused funds, or other market instruments that reflect real-world demand. Currency itself can also function as a store of value, but not all currencies are created equal. In a world where money is no longer backed by gold, economic stability and geopolitical trust matter more than ever. Some currencies have historically maintained strength during periods of global uncertainty because they were supported by disciplined fiscal policy and stable institutions. This is why capital tends to flow toward certain currencies during times of crisis. Investors who want exposure without opening foreign bank accounts often use regulated currency funds or platforms that allow access with relatively small amounts of capital. Government-backed securities offer another layer of protection. Modern currencies are supported by the credibility and strength of the governments behind them. While no system is risk-free, strong nations treat defaults as a last resort because it would undermine their entire economy. As a result, debt instruments issued by stable governments are widely considered among the safest investments available. They generally provide better returns than idle cash, while offering high confidence that obligations will be honored. For those seeking growth beyond preservation, equities play an important role, particularly companies with proven business models and consistent cash flow. Not all stocks carry the same risk. Businesses with established demand, strong balance sheets, and reliable dividends tend to behave differently from speculative growth companies. For investors who don't want to analyze individual businesses in depth, diversified funds focused on financially sound companies can provide exposure without the complexity. Real estate has also stood the test of time as an inflation-resistant asset. Land is finite, population continues to grow, and the need for housing, commercial space, and infrastructure never disappears. While property ownership once required significant capital, modern structures now allow individuals to invest in real estate through pooled vehicles that generate income and long-term appreciation. Real estate doesn't just protect against inflation, it can also generate cash flow. Finally, there is a category of assets built on rarity and cultural value. Certain collectibles, whether art, watches, classic cars, or historical items, derive worth from scarcity and demand rather than utility. These assets aren't for everyone and require deep understanding, patience, and access to the right markets. When approached thoughtfully, they can act as long-term repositories of value. New platforms have also made it possible for smaller investors to participate in these markets through fractional ownership rather than outright purchase. The common thread across all of these assets is simple. Wealth preservation isn't about chasing the highest return, it's about avoiding silent loss. Inflation doesn't announce itself, it works slowly, quietly, and consistently. Protecting your financial future means understanding that cash alone is not safety. Real resilience comes from owning assets that hold value, create value, or represent something that cannot be easily replaced. When you think this way, money stops being something you simply store and becomes something you intentionally position.